Mark Andreessen said, tech is eating the world. But how do you actually analyze this and take it forward? That is exactly what we talk about in the next session with Mr. Rahul Chadha and Mr. Amit Khurana. The session is titled Investing in the World of Heightened Geopolitical Uncertainty and Tech Disruption. It is my pleasure to invite Mr. Amit Khurana, CFA, Head of Institutional Equities and a member of Board of Directors at Daulat Capital Market Private Limited. Amit Khurana is a seasoned financial market industry expert, currently serves as the head of equities and a member of the Daulat Capital's board of director. With over 2 decades of experience, he specializes in multi-asset and multi-sector investment strategies. Mr. Khurana's primary focus is research on the driving sector and the sales efforts for domestic and foreign institutional investors. His career has spanned both buy-side and sell-side of the financial spectrums, with significant roles at ILFS and PNB Mutual Fund on the buy side, as well as Collins Stewart UK and Birla Sun Life on the sell side. May I please welcome Mr. Khurana.
Thank you, Achal. Good morning to you all.
Good morning, good morning.
Well, we have the most apt the topics for the investment conference today. Investing in a world which is going through generational geopolitical shifts, where traditional investment frameworks are being challenged by new business models, and technology and AI-led disruptions are making it almost an existential urgency to realign our way of work. How do we as investment professionals rethink, re-strategize, and redefine our actions on a day-to-day basis and medium to long-term basis is the need of the hour. How do we redeploy our energies towards the productive side of thinking and take out the noise out of so many tweets and so many real-time news flows that we get to see every day, every moment, every hour? Well, our speaker for the session is exactly trying to reframe all these aspects, and I'm pleased to welcome Rahul Chadha for the next session. Rahul is the founder and CIO of Shikhara Investment Management, a firm which is focused on India and Asia equities. Prior to this role, he has been the CIO of Mirae Asset Global Investments, managing assets worth $6 billion, and he is a master's in finance and control from Delhi University and an alumnus of the Wharton School. Please join me to welcome Rahul Chadha.
Good morning, everyone. Thanks for this. When Shabit reached out to me saying, why don't you be a speaker at this flagship event, the thought was, what should be the topic? We wanted to have something which is of interest to everybody, and which is where what we thought was share something which we all are grappling with, basically, which is how does one invest in this world of heightened geopolitical uncertainty? And more importantly, it's not only about geopolitics, but it's the tech disruption. Just a brief kind of a background about my own self. I've been 25 years plus in markets on buy side. Currently, I'm based in New York, but prior to that, for last 15 years, I was in Hong Kong. I moved to New York about 2 years back. If you look at the name which we chose for our firm, we started Shikhara about a year back. It was Shikhar, which people here would know is the Sanskrit word for peak summit. And the thought process was that what we need today is a vantage point which is able to steer through the noise, which is able to see through the noise and get your second, third level thinking. So this is what is our firm all about, Shikhar all about, or Shikhara all about. Let's talk about what we have here, basically. What is happening today is the global power dynamics are shifting. We are moving from a unipolar world, which we saw over last, in fact, 20, 30 years now, to a multipolar world, and it's the rise of China. And I think the pace which China is coming and dominating different fields has been unprecedented. A lot of Indians love cricket, and I think for people of my age, The first experience was Jayasuriya coming and doing this in ODI, and everybody was shocked. And then you had Sehwag in Test, and then what do you see in the T20s now? But that's kind of a thing which is happening. These countries clearly realize that you're dominating the critical technologies like AI, semiconductors, quantum computing is going to ensure who dominates the world for next 20, 30 years. And China started this. And I was in Hong Kong, and being in Hong Kong in 2013-14, one saw very clearly that China had this 10-year program to dominate the technologies of future. They were bringing the Chinese professionals from outside back home, giving them good incentives, etc., so that they could do that. And we see that play out today. So if you look at technologies like EVs, completely dominated by China, look at renewables, completely dominated by China, etc. And it's happening in more and more fields. Leave aside the high-end semiconductor manufacturing, which China doesn't dominate, but more and more fields they're dominating, and I think that's what's leading to the friction between the US and China, where 2018 onwards, US limited the access the Chinese companies had to the high-end technology. And this is also bringing back the growth model we saw until 1985. So if you look from 1920s to 1985, the world was a lot about state capitalism. You had the Germans first, and then ahead of the Second World War, the Americans investing in state-of-art technologies. Then post the Second World War, it was the Japanese coming and investing, and that got followed. China did that for the last 20 years, and that's what countries realized, that China scored a significant edge over others by doing this. So you're seeing a form of state capitalism come through. Closer home, we see that in India with what's happening in the PLIs for certain industries. Again, what is also happening is, while this was playing out, there are domestic pressures which are fueling all the tension. First and foremost was this migration which was happening. Look, we see here, and as you travel across Europe, you will see the migration which has happened from Africa to Europe. There are parts of Europe which look very different from where, particularly in France, which look very different from what they were 10 years back. It's okay for a while, but after 5-7 years of migration, when people see the social fabric of their neighborhoods change, what's happening, the kids in their, or the peers in their kids' classroom change, etc., there is a little bit of a pushback which comes through. And these are interesting numbers to see. We saw the migration go down in 2020 because of COVID, but look at the significant uptick which has happened. And something which I'd like to highlight is something, the migration which has happened in EU, where the numbers per 1,000 people have moved to 5.6. Look at UK, 11. Look at Canada. Look at Australia. Canada, Australia is where you're getting the pushback against these migrations, because people are realizing, the locals are realizing that the social fabric is changing, and as humans, most of us don't take the change kindly. So that's what's happening. Also, there is this fear of AI's impact on jobs. So that's coming through over last 3-4 years. We're seeing AI impacting jobs, and it impacts the white-collar jobs all the more. Like I jokingly say, living in New York, when we need a plumber or electrician, one visit is $150 basically. So it makes sense to, whatever, as Asians, we'll never do it. We joke about it. It makes sense to put your kid to learn these skills rather than go to the uni and end up spending 200,000 and still look for a job there. So that's the joke. But this disruption is going to hit. And again, insecure minds, insecure people look towards these politicians to prevent, to give us solutions. Very often, those solutions are not the most optimum ones. So the wealth gap is at a historic levels. You've got, particularly in US, healthcare costs are huge. I jokingly tell people that I pay close to $2,500 a month for my employees in US for their healthcare cost, and this is the amount I pay for the whole year for our team members in Hong Kong. So clearly somewhere it eats into your total composition. You can see the pressure. And what we saw recently, where United Healthcare CEO was shot outside Hilton, so it's like Oberoi's analyst meet, somebody come and shot this, is really the simmering discontent in the society. Again, how do we then adopt to this uncertain world? What we're seeing is friendshoring kind of a come through, We're seeing post-2018 supply chains move away from China. To understand why this is happening, it's very important to see what happened in the world 2007 onwards. See, most MNCs started sourcing from China 2003-4. China joined WTO late 2001-2. And their sourcing experience from China was so phenomenal that they ended up sourcing 60, 70, in some cases 80% of the production from China. Now, if you're a manufacturer, you'll always diversify, but nobody could match the scale. Nobody could match the speed. Nobody had the infrastructure. So the easy thing was source from China. And when the trade war happened, it was like, we're too much dependent on China and we've got to do China +1. So that's where the shifts are happening. The Chinese manufacturers are smart. So what we saw was 2018 onwards, most of these Chinese manufacturers set up plants in ASEAN, set up plants in Mexico to supply to US and other European countries. So what we saw was what we have over there on the right side, the rise of Global South. What is Global South is the LATAM, is Africa, is Middle East, part of South Asia in terms of new export destination for China. So we've seen Chinese exports to US down by 4-5% from 2018, but exports from the Global South pick up to US. And within again, China and Global South, the numbers have increased considerably because these countries have grown much faster than the developed world. So that's the story. This is quoting a survey UBS did from a UBS Evidence Lab, where they asked people in terms of supply chain shifts from China, where would they move production? Because the Chinese manufacturers, again, are very clear that they realize that this is going to happen. Tariffs, restrictions are going to come now from US, subsequently from EU. So they need to diversify out. So they are taking the lead. We've got the likes of Japan, Korea, now ASEAN countries like Vietnam, Malaysia doing exceedingly well. India came up, but now it's down. India is more looked by FDIs, more looked at multinational corporations as a sourcing base because it's got a great domestic market. But the Chinese manufacturers themselves are looking more at Japan, Korea, and the ASEAN countries. Something to say here is the scale. We've invested in Vietnam for about now 7-8 years. And I remember talking to one of the Chinese furniture company, Manwa. So Manwa was looking to diversify out of China, but the capacity they wanted in Vietnam would have taken the entire furniture making capacity. So the scale which China had is very different. To give you numbers, most of these ASEAN economies are 200, 250 billion in GDP, and China is 20 trillion. So for China, is losing a drop in the ocean. For these guys, is significant numbers. What is all this leading to? Again, all this instability leads to populism. We saw that in India also. Look at the amount of trade interventions. And that's where you require a change of investing mindset. I remember 5 years back, people used to say, buy steel stocks because locally here, government is going to put tariffs. And you're like, we've never invested that way. You've invested from a free market perspective for last 15 years. And I think now, as investors, we've got to reconcile to the fact that markets are going to be protected. It is going to be common accepted that tariffs are going to be imposed. And look, it's not really that one country is doing. Multiple countries are going to do that. And the amount of trade interventions announced bear testimony to that. So this is exactly opposite of what happened 1983, 1985 onwards, when you had the Margaret Thatcher, when you had Ronald Reagan, and then subsequently you had globalization. So everything's kind of reversing here. Again, economic nationalization is coming. You've got, again, all this friendshoring which is playing out. But not all is lost. I think the big trigger, the big thing is going to be AI-led productivity. And why we talk about that is the last time we saw meaningful productivity growth in US was between 95 and 2000, when we had the Y2K era, when you had the infrastructure spends, etc., where the productivity growth was 3 to 4%. You see that same, and we saw a little spurt come around in 2000, post-COVID, and the belief is the same thing kind of comes as AI goes mainstream in the coming years. So this is the positive for the market, and I'm sure we're going to discuss in Q&A a lot of these things about US interest payments, the debt situations, etc. But remember, this is the bright spot for markets globally, and the productivity growth kind of gets you growth with lower lower inflation and lowers your equity risk premiums. That brings us to the other aspect, which we as investors today have to grapple with. We talked about the geopolitical aspect, but the second equally important aspect in investing today is the rising tech disruptions. So first and foremost is AI, and then I'll talk about here platforms, obviously, who've taken the competition, who've taken the game to a different level. But just to leave you with some thoughts here, basically, what is happening here is you're seeing companies adopting the new tech to scale and improve efficiencies, and that kind of deepens the moats, and AI is the big frontier. What we did here was looked at last 50 years and look at these big changes which have come. You've had major technology cycles. You had the invention of PC in 1980s. Then you had what we were talking about, the dot-com era, which we saw 96 to 2000 onwards. iPhone 2007, where we saw the whole bunch of apps which came around it. So the apps we see today, Meta, Instagram, Uber, etc., all were kind of a result of this iPhone app era. And then 2022 is the AI era. And it's amazing how you're seeing these companies. And the good advantage is being in US, you see all these things firsthand. What is the name of the game about? The name of the game is all about hyper-personalization at scale. So what are advanced algos doing? They're giving you all the data. And then it is the quality of your managers, what do you want to do? A good example which we've quoted to our clients and shared in our literature is something which Puma did. And they were showing an ad. So for a Japanese kind of an prospect, or for a Japanese customer, it was somebody running with Mount Fuji as a background. For somebody in India, it was the local background. And that's what you can do. So you can slice, dice, again, your target consumer well and see what he likes and show him something which is a lot more personalized, basically. The long-term drivers are AI integration in sectors such as healthcare, automotive, etc. Asia is the epicenter of this tech innovation. Very often when we look at the tech innovation, we are looking at NVIDIA, we are looking at US, we are looking at guys like Micron, we are looking at the big data center capex which happens through Microsoft, AWS, Facebook, etc. But what one's got to understand is the innovation happens there, but the production happens here. So all this is possible because you've got a TSMC which is able to produce these chips in the 2 nanometer fabs. You've got a Hynix which is able to give this high bandwidth memory which enables the processing of this. Closer home for India, I think the opportunity is for the Indian IT service providers. I remember I was asked this question a number of times that does AI mean the death of Indian IT services company, because this is going to mean significant deflation, you'll have AI coded. But I think what it kind of showcases also is the unique ability of the Indian IT services company on how they have lived through these cycles. They are nimble, they have scale, and they're quick to learn technologies. It happened with them in 2007-8 when they embraced ERP. It happened with them in 13-14 when Indian companies embraced cloud, and it's happening again with them in AI. And what's happening in AI is, I think the big story in AI is going to be the top 100 corporates globally embracing AI as a productivity improvement tool. So what we hear is last 12, 15 months have been all about pilots. Nobody's been sure on whether this is going to work or not. See, the likes of AWS, Azure from Microsoft, or Google do is they give you processing capabilities or the capacity. And you have huge amount of data, etc. But you need something to marry the two, basically. You need software to be written so that you can analyze your data. And that's going to be done by the IT services companies like TCS, Cognizant, Infosys, Accenture, etc. And I think recent numbers we saw from TCS bear testimony to this, that you've got a, $10 billion order bookings growing by 40%. So this is the big story. And I think that again also shows us how do you survive the uncertainty by building a new skill set and being flexible, agile on the same. This is another thing I wanted to talk about. These are the new digital champions. And I think what one has to do is watch these companies closely because they've taken game to a different level. And what I've done here is everybody knows about Zomato. 60 million annual users, close to 20 million monthly users. But I brought all the top platforms from Asia, and each of these names are the names where we've invested for last 4 or 5 years, so you know them well. Something like a C has close to 500 million users, dominates ASEAN market, something like Indonesia for e-commerce, gaming spends, etc. And what the scale has done is given them a network moat. We call it the flywheel effect. Because you have so many users, the suppliers want to come to your platform. Because you've got a good data on users, you can show the relevant products, etc. You get economies of scale through your suppliers. You understand your suppliers, working capital financing, you can offer them loans. So started by Alibaba, but followed by these guys. And again, what somebody like C through their Shopee e-commerce business has done is build robust operational infrastructure. So that gives them the edge. Now the challenge is for incumbent brick and mortar companies to fight these guys. So Unilever Indonesia has got derated over last 10, 12 years because the consumption's moved to a platform like Shopee. And I think that is something we are seeing in India also with the rise of Blinkit and other platforms, that you've got the platforms like Zomato and Swiggy capturing it. We come to Zomato, again, dominant position in food delivery. And I remember we were early investors in the name, thanks to us being in Meituan from 2016 onwards. But the first network effect came from the integration from restaurant supplies to payment solutions, superior economics, the very fact that you've got riders, 100,000 plus, gives you a leverage which nobody else has. And then you understand consumer cohorts. You have a foot in the door for Sec A, Sec B households, and it's all about gaining share of the wallet. The success they have with their events business bears a testimony to that. Similar story, Meituan, 70 million users, started with food delivery. Then they have in-stores where what they're doing is selling some of these hotel inventory, rooms, etc. What they're doing is selling some of the services, etc. Lastly is a name I'd like to highlight, PDD, Pinduoduo. This is a name which started in China, and we're going to see more and more of this, having dominated, or they were a lot more agile. And I remember back in 17, 18, we were thinking that can PDD win against Alibaba, because Alibaba had dominated from 2004-5 to 2018 in China, and PDD came from behind in a unique strategy, dominated Alibaba in China from a unique value proposition strategy. Again, they started as an agri platform and then moved into other goods, etc. But having dominated in China, now they've gone global, and they are among the top 3 platforms in Europe, in Japan, parts of Southeast Asia, and US. The only threat for Amazon globally is PDD, basically. So they have close to 680 billion users, MAUs are 80% of Amazon, and a crazy level of scale, operational efficiencies, etc. And of course, the strength comes from the data you have. See, what we've got to understand is, we're going back to this, that these platforms have amazing data. They have the agility. They know what the consumer wants. They can respond quickly. They've got economies of scale, and they are not fearful of failing fast. So what they believe is failing fast, iterate, and keep doing it. And that's how the moat gets deepened. How do we navigate this whole landscape at Shikhara? This is because of the footprint we built. So I moved to the US about 2 years back, and when we were setting up Shikhara, it was very clear that, look, next 10 years are going to be the most chopping times or uncertain times for investing in markets. And what would set you apart is the unique insights, the knowledge you have, and how quickly you implement that. See, today if we see, whether it's US, whether it's Asia, 1/3 of the market turnover is quant funds, and is these multi-manager platforms, the Millenniums, the Citadels, and all these guys of the world. So it's hard for an active fundamental investor to kind of navigate against that. And this is what our kind of a solution or proposition is, basically, that I'm based in New York. I've got a senior analyst with me, 30 years experience, and between us, we look at macroeconomic and policy insights. US is the innovation hub for tech, so you know what is happening. You see business models firsthand. Then we've got a team in Hong Kong, which gives us a good breadth of research across Asian markets. China is the second largest economy in the world. China is truly something who can compete against the US. So you get access to China, you get access to what is happening in terms of technological developments in China, and then we've got team on ground in Mumbai, because clearly we believe the next bunch of multi-baggers are going to come from India. So you've got to find the right space, you've got to ask management the right question. And for you to be able to ask management the right question, you've got to know which questions to be asked. So you need to have those insights, those learnings, and that's what comes through. And trends replicate across markets. So much as we talk about Asia as a homogeneous thing, but it's very heterogeneous. It's evolved over a period of time. We first had Japan in 60s, 70s, followed by Korea, Taiwan, and then it was ASEAN, China, and now it's India. So that's really the reason why investing in Meituan allowed us to pick something like Zomato. It's important to also talk about investment philosophy here, and these are broad rules on how do you look at investing in markets, etc. What we take is a best-in-class approach across sectors. We believe that businesses are run by humans. Humans are driven by emotions, and emotions border between hubris and humility. So what we see is, and why this is important is that this is important more so in India, where we've had a decade of good performance for the consumption sector. For those who've been in market long enough, until 14, most of these consumer companies used to peak at 35 times earnings. So it's only the generation which come, and I've got analysts who've got 10, 15 years experience, it's only the generation which has come recently has seen these valuations. People who've been long enough know that these names used to be there. So what happens is when your names are trading at 50 times, there are other players on sidelines. We saw that in paints, we saw that in NBFCs, who are saying there's so much market cap to be made in this sector. Let's put more resources here. And we saw competition in paints, and look what happens to the profit, what happens to the profitability, and eventually as the profitability comes under pressure, the multiples come under pressure. At the same time, there are sectors like infrastructure which were ignored, and that creates opportunity to play from a medium-term perspective. So that is what we are saying. What we play is, or what we kind of an approach is, take a best-in-class approach across sectors, focus on intrinsic value. The endeavor is to back managements which are visionary, category disruptors, have good execution skills. What we believe or back is operating leverage rather than financial leverage. So operating leverage is what we want to play. You don't really want to buy into a levered company and see that the cycle doesn't play out for a couple of years and to see your company go bankrupt or come under pressure. Again, it's a dynamic approach. It's not confined to any single investment style, which allows us to adapt and thrive in cyclical markets. And what we're going to see is shorter cycles in the world today. See, the reality of the world is last 10 years, between 2010 to 2020, it was only China which was investing in infrastructure. The rest of the world was kind of underinvested. For people here, you would remember JPA, that went down under. We had an investment boom in India between 2003 to 2007. 2009 to 14 was completing those power projects. Some of the companies went down under because those projects could not be completed in time. And post 2013-14, almost there was no new capacity which came into the power sector. And similar thing happened in the US, which is why there's a huge opportunity. There's an opportunity almost for the next decade in terms of creating new power plants, the supporting or upgrading the transmission and the distribution sector. So that's the infrastructure opportunity. The unique approach also which we follow is take ESG as a differentiator. So again, like the way in the decade of 2000, your backward integration, having iron ore, coking coal was an edge for your resource intensive industries. I would say the top quartile ESG footprint is going to be the edge for the coming decades. And we've seen what's happened in California. The fires in LA are raging. And I think it's going to get all the more pronounced. I live in New York and I see people there used to just almost shrug off this climate change. But we really cannot wish this away. And this becomes a big edge, a value creator for the next decade in this. Benchmark are backward looking, don't look at benchmarks, etc. Bottom up stock picking to identify future winners. And as this disruption plays out, there are going to be opportunities for people who can short in some of these names. But more importantly, one's got to be mindful of understanding the businesses well before you buy. So that whole thingy of buying on dips may not work because as stocks come down from 60p to 45p doesn't mean it will go back to 60. People who've seen cycles long enough know that stock may go even lower to 20, 25 times earnings. Just talking about the case for Asian markets, I hear all the time about US exceptionalism. And obviously, living in US, obviously, everywhere you see issues, and US has its own set of issues. But I think that's something which has been pushed too far. If you see, most of the global investors are a bit complacent in terms of the US exposures. And at the same time, what we have is EMs, particularly Asian markets, which are 80% in those EMs, ignored. Earnings tractions are going to be good. Coming years, we'll see earnings growth higher in higher in Asia compared to US. What we see is, particularly in North Asia, this buybacks coming through, dividend ratios being increased. This kind of came from the value up program, which played so well in corporate Japan, being followed by the Koreans and then followed by the Chinese, which is where you somewhere have a flow to the yields. The valuations are very cheap, so you've got a great downside support. And I think the most powerful chart here is the relative valuation. So relative valuations of Asia, EMs versus GM are a 30-year low. So if you've got a more than 1 year perspective, I don't think one loses money here. When we talk to the big endowments, big investors in the US, the view is that over next 6 to 9 months, increasingly, people would look to allocate more to EMs because everybody sees the values, everybody sees the quality of the company. See, anybody who kind of meets the companies in India sees the top-notch companies. You go to China, you meet the likes of BYDs, you see the work Xiaomi is doing, Tencent, Meituan, etc. The great bunch of companies. And in US, these global companies would be trading at 25 times. In China, these companies set their foot outside China about 3 years back, but next 5 years, 25-30% of revenues for Trip.com, for somebody like BYD would be coming from non-Chinese markets, and they're still trading at sub 10 times P. So that's a big story. Like something like a Pinduoduo trades at 5 times forward earnings. You've got Amazon, which is 25 times. And Pinduoduo is a lot more competitive. They've got much better sourcing in China compared to Amazon, which also sources from China, basically. This is also a chart to sit back and reflect on, and more so in today's time when one is negative or you hear a lot of pessimism from a short-term perspective. Look, markets corrected, and it's amazing. This is the fun of markets. I remember September when I came to India, everybody was so complacent. It was like you can close your eyes and make money in market. I was on a plane. This was from Delhi to Mumbai, and I had somebody sitting next to me, and he was showing the charts and saying, "Look, I do only technical analysis," to his friend who was on the aisle seat, saying, "I do only technical analysis, and that's how I make money. I don't look at fundamentals, etc." And then the friend who was at the aisle seat goes and says to him that, "Look, I've heard HR is calling people, means there's some restructuring in the company. Have you been called?" So this guy who was sitting next to me goes, "No, I've not been called, but in case I get the pink slip, I'll get about, 10 months of salary, which I'll invest in market." So the point I'm trying to say is everybody was so complacent. The mood was almost euphoric. People thought you could just come, buy some options, make money. It's like daily some bet. So those kind of things never work. And now what we see is more pessimism kind of coming through, which is why something like this is important to put the medium longer term in perspective. Look at the growth rates we've had in Asia. Look at the opportunity. What's very, very important is the talent pool we have. And I think this is the big edge. China produces close to 500,000 engineers every year. India does 250, 300,000 engineers. People are hungry. There's a strong nominal GDP growth. And I think that is where you get opportunities. What we've done here is shown sectors. Last decade has been healthcare, infotech, something in consumption also. The previous decade was asset-heavy sectors, resources, etc. Key markets for multi-bagger ideas have been India and China. So that gives us the confidence that, look, if you've got nominal GDP growth rates of 9 to 10% over the next decade, opportunities are going to come. In China, the growth rates are going to be slower. But look, The valuations are very attractive over there. They've got economies of scale. And for them, it is looking beyond the domestic market to global market. And I think that's the opportunity. I'm just mindful of time, so I'll just leave it at here. How are we playing this at Shikhara? These are the themes in our portfolio. Tech as a competitive advantage. So you've got the likes of TSMC, MediaTek, Hynix, which come over there. Indian ID companies, Cognizant Technologies, becoming global champions. So this would be from representing or investing in companies from China and Korea. So Chinese companies would be BYD, Trip.com, Xiaomi, or Korean companies would be Hyundai Motors, winning local mindshare. Something like Zomato fits in very well here. A Vietnamese play, which we jokingly call the Titan of Vietnam, P&J, trading at 12, 13 times earning, having the similar story, the young people in Vietnam wanting branded jewelry, moving towards the latest designs is the play over there. Something in China which is playing out is Proya. Proya is kind of a, I think, a much bigger version of Honasa we have in India. This company's been around for 25 years. And what we see is, having been around for 25 years, understood the local taste well, understood what the local consumer wants well, improve their product quality, sell the same product at 50% cheaper price to Estee Lauder, gain value share. So today when you have the Shiseidos, you have the Estee Lauder struggling in China, Proya is growing 20-25% every year. And that's the local winner. So these are the guys who are winning local mindshares. And then comes the theme of industrialization, which is largely infrastructure plays or some of these industrial companies in India. And that is a 10-year story. You'll get mini blips, etc. As the government retrenches the capex spends, these stocks are going to correct, but one would like to add on dips here. You've got the big story which is happening in China. Like we've got something like a Hyundai Electric, which sells transformers to, sorry, you've got the big story which is happening in industrialization in US. So we've got something like Hyundai Electric, which sells transformers to the US. Transformer pricing has gone up 3 to 4 times because in US for last 20 years, there was not much investment in transmission, distribution capacity. There was no electricity growth. Now because of AI, now because of all these things, there is a 3 to 4% growth. And the risk for AI is the infrastructure is not ready from a medium-term perspective. Lastly, aging population. Aging population, all the literature talks about aging population in Korea, in China, but in India also there's a large mass of people who are aging. What you also have in India is, because of poor air quality, etc., huge amount of these disease incidents come through, or adulteration in food, you've got higher kind of, or lifestyles, you've got diabetic patients, you've got respiratory disease, you've got cancer disease. So opportunity comes in hospitals. That's a space we've liked for a while. Opportunity comes in local pharmaceutical companies. Similar to what we talked about, the innovation happening in other sectors or the platforms or consumption sectors in China. We've got Chinese companies like Hangzhou, who 5 years back were getting 70% of their sales from generic drugs. Now they've reversed. In last 5 years, 70% of their sales are coming from innovation drugs. In fact, Hangzhou signed a deal with Eli Lilly, where for their, again, this GLP drug, they are designing the oral dosage form. So I think these are the interesting ideas. And then, Amit, I'm all yours for questions here.
One of the very first questions which I thought is worth highlighting is what is in the buzz today is Trump 2.0, which is literally at the doorstep. Now, Trump as an individual has his own characteristics. The US is going through a major transition. It has its own ramifications for the world. And probably the abruptness and the disruptions it will bring about. How are you positioning to navigate these times for the next 12 to 18 months?
Yeah. So I think first thing which I'll say here is the second term is all about leaving a legacy. And that's what one's got to understand. So we jokingly say what Trump wants is US to have for next 4 or 5 years of his term 3% growth, fiscal deficit to be around 3%, and then to produce that 3 million barrels of oil. So which is where a lot of this noise, rhetoric on tariffs is going to be more of a negotiating tools. There is no way US can put 60% tariffs on China. There was going to be far and few, because at the end of the day, these tariffs are going to be paid by US consumer. I lived in Hong Kong for 15 years, 2 years I've been in US. What we joke is, in US, if you earn 500,000, it's hard to save anything because tax rates are high, everything's so expensive. So things got genuinely very expensive in the US. And the reason why Democrats or Biden government, and where Harris was kind of campaigning, got voted out was because of inflation. Migration was one issue, illegal migration was one issue, but again it was inflation. So I think market is going to be very positively surprised on this. There's going to be a lot of noise, there's going to be a lot of chaos, but the actual incidence is going to be a lot more lower. Where people are watching this space is what happens to renminbi. So renminbi has been fairly stable. So look, the currency has been stable. China's trade surplus for last year was $950 billion. And if renminbi is stable, most EM currencies will be stable. There is an emotional thing about rupee going towards 87 or 90, etc. But let's understand, rupee has been very stable for last 4 or 5 years. We've seen rupee move from 45 to 68, 70, but last 4 or 5 years has been stable. So I'm not that pessimistic.
Understood. That's very helpful. One of the highlights you made in your presentation was the resurgence of right-wing political ideology coming into play. That has its own impact on multilateral institutions all across the world. Is it fair to say that the era of multilateral institutions is over and we are more to bilaterals, wherein each country will talk about its own interests on geopolitics, economics, trade, whole lot of other domestic related policies? How does that redefine the investment framework for us as investment managers?
So I think that's a great point, Amit. The rise of multilateral institutions coincided with the rise in globalization. As we are moving towards a more insular world, as we are moving to these bilateral trade blocks, I think a lot of these multinational institutions are going to be undermined. Look, everybody complains to WTO on tariffs being put. What has happened post that? The natural reaction was, look, you put tariffs, I'll complain to WTO, but nothing comes out of that. So somewhere you've undermined this, and I think that's the point, which is where I said, looking at the steel companies example, I remember the first time tariffs were put, or there were market talk of tariffs being put on imported steel from China. We thought, again, Tata Steel or some of these steel companies are not an investment idea, but we were wrong there because the world's changed. So I think that's something one's got to be mindful of.
Got it. Let's come towards the China angle, because that's going to be the focus for a lot many investors and whole world to look at it as to how the transition with China is trying to do from the manufacturing powerhouse that it has been for the last 2 decades. And now with MAGA coming into play, China plus one supply chains, which have suddenly become the buzzword post-COVID, and China's own conscious efforts to move towards domestic consumption.
Yep.
Now, if we were to draw a big picture as to how the key stakeholders would manage this transition, the behavioral aspects, the sort of the shadow boxing which could go around, how would you draw this picture for the next 2 to 3 years between China and the US and the other key stakeholders? How could it play out?
Look, it's going to be a complicated world. There's going to be a lot of back and forth. See, what is happening is, and I'll give you an example. Look at what is happening in Europe. You've seen these Chinese companies come, particularly the Chinese EV companies like BYD, come and dominate the scene in Europe. Look at what has happened to Germany. First, we go to China and see some of these JVs which were with foreign companies. They've lost market share big time. Who would have thought? I remember 3-4 years back when we were looking at BYD share, we were like, boss, there's no way BYD can keep a 35% market share. They've got a 35% market share. We've got Xiaomi and all these new entrants coming. So I think that is not going to be a smooth, easy transitions. They're going to be winners of the coming decade. And the winners are going to be people who embrace technology, who are agile, etc. So those are going to be changes. The way out for this is we will see some of these companies like the BYDs, Xiaomis, or the Chinese other consumer companies set up plants in Europe. We've seen them put that plants in Hungary, etc., to cater to the local market, and that's how you create jobs. We see that in India also. So from July onwards, relationships have improved between India and China. You're going to see a lot more investments coming from China into India, because the fact of the matter was, look, the Americans are investing back home. The Europeans are lost on how to grapple in this world. So it's the Chinese who have the money and who are looking to invest. So if you want FDI, you've got to be on the right side of the Chinese. Yeah.
Sure. I want to steer towards the India perspective now. Very often you hear, and as a sell-side analyst, as a sell-side strategist, I hear investment managers saying India is an absolutely expensive market. Do you agree with that view at an aggregate level?
So I think valuations are not cheap in the market. And look, one's always got to understand this. Much as we fund managers talk about expect 15% returns in market year after year, is never really a smooth ride, yeah, because a lot of this is also a behavioral element. And when markets do well, people get excited, they suck more investors in. And there's always an overshoot. Similarly, in tough times, there is an undershoot. So one's got to be mindful of the fact that, look, in India, we've had great returns for last 3 to 4 years. Some of the mid-cap names are up 5, 7, 10 times. Those names are going to take breather. Yeah? So it is but natural to understand, appreciate that. What we are doing as a team is do more work on the business models you want to be invested in the next 10 years. Do more work on managements. Do these managements have it in them? What we do as an exercise is right to win. Is this management on top of what is happening in the sector? Do they know the competition they're getting globally? What we're doing in our portfolios is preferring a company which also have an export angle, because there's a big global market, there's an opportunity. What you want to see is these companies, some of these auto-anchor companies, some of these medical consumable companies who've been in India for 30 years, they've kind of streamlined their processes, they've got a critical mass, can they gain global share? So for us as a strong domestic franchise, plus this optionality of gaining global shares, that's a way to navigate these not so cheap valuations.
Understood. Any specific sectors that you feel pretty positive from a medium to long-term perspective from the Indian corporates, the way they are positioning, adopting technology? Are there any specific sectors that you feel very, very positive about?
So I think let's leave aside next 6 months. Markets are going to be choppy. From our portfolios, we are more towards large cap tech, pharma, etc. But our view is somewhere in the second half of this year, as the markets realize that EMs are cheap, you're over-invested in US growth rolls over. And why US growth will roll over is we've seen fiscal tightening everywhere in the world, but for US. So these bond yields spike going to 4.5% or even 5% will force that tightening. What you've seen is that COVID surplus kind of a dwindle significantly in US. So you've seen bottom of the pyramid in US come under pressure. So as the growth rate slows down in US and the worst of the tariffs doesn't play out and EM currencies kind of a stabilize, money will move out of US to EMs, etc. So that's where you'll get opportunities, obviously, or that's where you'll have re-rating kind of happen for this mid-small caps. But over next 6-9 months, one would like to add pullbacks, add to these mid-small caps. Opportunities would be in industrials. I think that's an under-invested space in terms of the end markets from a 10-year perspective. That's where opportunities is. Opportunities is stock-specific, like the way I said. Look at some of these auto-anchors, etc. Look at the healthcare space. That's opportunity we've liked. Real estate as a sector, still in the early phase, mid-cycle for that. I think these are the broad opportunities.
Got it. I've got a list of questions. I'm trying to pick up a few and try and do justice. Your view on US focusing more on integrating cryptocurrency into the mainstream and Bitcoin ETF underway, cryptocurrency in general, about the value and return.
Yeah, so I think that's a tough question. See, it's like throwing a dart, and it's more of, you've seen the euphoria which has come in Bitcoin, and that's largely come because people thought or believed that the new administration would be in favor of it. But it's hard for me to derive a value for it. If you want to play something as a hedge for financial repression which comes in the world, and this financial repression is going to come because you've got most of the developed markets which are saddled with high debt to GDP. Their interest burdens or interest costs are increasing. As me and Amit were discussing, for last year, US had almost 20% of the revenue go as interest payments. And that was when yields were 30% lower. Imagine when the yields move up. So eventually what you'll have is governments come around and either force their domestic savers to buy their debt, something which happened in Japan. And what it means is then capital will look for alternate assets. And that's a story for Bitcoin. That's a story for gold. I'm still old school. I'm more in the gold camp. So I would keep gold as 10% of my portfolio. I remember my favorite was the gold bonds, the dollar denominated gold bonds issued by Government of India. So my wife bakes cakes, and in 2020, the cake which I got for my birthday was me wearing gold chains and telling people to buy gold. So I'm still in that camp. So buy gold.
By the way, the Indian housewives have been the best asset managers.
No, I think that's a joke and that's a smart one. Yes.
Yeah, absolutely. I have a very interesting question, which is, what is the impact of ESG conversations in the boardroom on Indian markets? Are you finding it meaningful, and will this be a limiting factor to our growth?
ESG at this.
ESG
See, I think what happens is ESG is clearly improving, and we saw that again. See, I'll give you a different perspective of this. See, these stock exchanges also compete with each other to get new listings. So in last 5 years, we had Hong Kong Stock Exchange, Shanghai Stock Exchange, Singapore Stock Exchange, tighten the listing norms or tighten the kind of a disclosure norms for the companies which were already listed. Same thing is happening in India. From investor perspective, investors are demanding higher standards of governance. You've got a lot of sell side where you've got analysts recruited to talk about ESG. So there's a lot of spotlight on that. Now, once you have spotlight, people who are slightly below average will improve their act, and that's happening. So ESG is clearly improving. We are not worried about that. What you're worried about is, look, what does the climate change mean for India? We've seen, similar to US, we've seen the floods happen in India. We've seen extreme weather conditions in India. There have been no studies done on productivity impact for India. There have been no studies done on health impact. You go to Delhi and, look, I belong to Delhi, and we were talking, Novembers, Decembers are hot. Yeah? You hardly get to see a clean sky, and I think Mumbai, because of the construction and similar thing. So I think those are the risks one would want the authorities to be aware of and some action to be taken.
Got it. We run out of time, but there are two specific things I'm going to make sure Rahul answers. He can't name stocks, but he's got to name his favorite Indian restaurant in New York City.
I think clearly that's Vikas Khanna's bungalow and this.
All right. And one final advice to the budding investment professionals. We've got a lot of young charter holders sitting here. What would you advise them when you're looking at their career?
Yeah, so this is what I tell my young analysts. This is what I tell myself and my 20-year-old boy. Control the controllables. There is going to be so much chaos coming at you, and in this world where we have so much information coming on Instagram, LinkedIn, etc., it's very easy to get overwhelmed. So believe in a strong process, control the controllables, and you will get the desired output. So don't try to control everything else. Focus on the process, focus on a little improvement every day, and you will get the desired results. Yeah.
It's been a great session. Great moderating the session with you. Rahul, pleasure. Thank you very much. Thank you for your time.
Thanks for having me.
Thanks, Amit and Rahul. I would like to invite Ms. Punita Kumar Sinha, former Board of Governors at the CFA Institute, to give you